most people still believe one simple story about China's currency: that Beijing will never allow the yuan to rise because a weak economy needs strong exports, because growth still depends on selling to the world. That story is now breaking, quietly, systematically, and with consequences far beyond foreign exchange markets. Today, China's currency is no longer being pulled down by weakness. It is being pushed up by excess, by a trade surplus so large it can no longer be absorbed, by savings trapped inside a closed system, by a global order reaching its tolerance limit. What looks like stability is in fact pressure building behind a wall. And when pressure builds inside a closed system, it does not disappear. It searches for an exit. If you care about where global trade is heading, about why tensions are rising even without a crisis headline, this is a story you need to understand. Stay with me, because before we talk about what happens next, we need to confront the illusion that shaped the old consensus. Then let's slow the frame for a moment and define the problem clearly. For years, the yuan was treated as a policy tool, something Beijing could hold down at will. A weak currency for a weak economy. Exports as the last reliable engine of growth. And for a long time, that logic worked. China's domestic demand was fragile. Private capital wanted out. Interest rate differentials favored the dollar. Money leaked abroad fast enough to offset China's swelling trade surplus. The system balanced itself. But that balance is gone. Exports are no longer compensating for weakness elsewhere. They are overwhelming the system. Net exports now deliver an outsized share of reported growth, and they do so at a scale the rest of the world cannot quietly absorb. At the same time, the capital outflows that once relieved pressure have slowed. The financial account remains closed. Savings stay trapped inside China. What emerges is a contradiction at the heart of the system. A currency held still while forces beneath it accelerate. To understand how we got here, we have to go back to where this cycle began. Then we need to rewind the cycle. China's exchange rate regime was built for a different era, an era when growth came from integration, when exports absorbed surplus labor, when global demand felt limitless. After the global financial crisis, that model hardened. Domestic rebalancing was promised but never fully delivered. Investment stayed high, consumption lagged. Exports remained the release valve. The yuan was managed accordingly. Not fixed, not free, stabilized just enough to anchor expectations. When external demand slowed, Beijing leaned harder on exports. When capital wanted to leave, it was allowed within limits to offset trade inflows. The system relied on counterweights. Then the shocks piled up. The pandemic, the property downturn, tariff threats, a prolonged domestic slowdown. Instead of shrinking, China's export machine expanded, not as a sign of strength, but of imbalance. Domestic demand did not replace foreign demand. It failed to catch up. What once looked cyclical became structural. And when a structural surplus meets a managed currency, history tells us something has to give. That brings us to the first visible rupture in the system. The first rupture did not come as a crash. It came as a signal. Global tolerance began to thin. China's export volumes kept rising, not by a little, by amounts that stood out against a slowing world economy. Imports, meanwhile, barely moved. That asymmetry mattered because it exposed something uncomfortable. China was no longer just competing within the system. It was straining it. Trade partners noticed, quietly at first, then publicly. Warnings surfaced, not about currencies, but about imbalances, about sustainability, about limits. This was the moment when the old assumption cracked, that the world would always absorb China's surplus. That exchange rates could remain a technical issue. They could not. The surplus was too large and, crucially, too persistent? Behind the scenes, institutions that once avoided the question began to shift. The yuan's valuation was no longer dismissed as a side issue. Undervaluation was named, its role in export outperformance acknowledged. This wasn't a policy change yet. It was something more dangerous, a change in perception, and once perceptions shift, markets and politics follow. Slowly at first, then all at once, that perception shift set the stage for a deeper, less visible mechanism. What drives this system is not a single decision. It is an interaction. China runs a massive trade surplus. Those export earnings generate foreign currency. But China's financial account remains largely closed, so the money cannot freely leave, and it cannot fully enter either. Savings accumulate inside the system. For years, private capital outflows solved the problem. Companies moved money abroad, households diversified. Those flows offset the surplus. That release valve is narrowing. Private outflows have slowed, but the surplus has not. So pressure builds. To prevent rapid appreciation, state banks step in. They accumulate foreign assets quietly, systematically. On paper, this looks technical. In reality, it is intervention by another name. But here is the trap. Keep intervention small, and pressure leaks into the currency. Increase intervention, and political scrutiny intensifies, limit appreciation, and the real exchange rate stays undervalued. Allow faster appreciation, and offshore money rushes home. Every path creates a new imbalance. This is why the yuan is no longer a one-way depreciation story. It is a managed pressure story. And the pressure is upward. The system is still holding, but it is doing so by tightening its own constraints. That brings us to the second, more dangerous inflection point. The second inflection point comes from behavior, not policy. For a long time, betting against the yuan made sense. Rate differentials favored the dollar. The domestic economy slowed. Risk pointed outward. That logic is fading. The currency has stopped sliding. It has begun to crawl upward, slowly, predictably. And that changes incentives. Exporters notice first. So do currency traders. If appreciation is capped but depreciation is unlikely, the asymmetry matters. A slow grind up with a small chance of a bigger move is enough to shift expectations. Firms that hoarded dollars during years of uncertainty begin to rethink. Not all at once, but gradually offshore cash starts to look temporary, not strategic. This is latent demand for the yuan. Demand that does not appear in trade data. Demand that waits for confidence. Here is the danger. The more predictable appreciation becomes, the more money wants to come home. And the more money comes home, the harder it is to control the pace. To slow it, intervention must increase, not decrease. China is approaching a point where stability requires more action, not less. More management to preserve the appearance of calm. This is not a crisis yet, but it is the moment before one becomes possible. And this is where the story stops being abstract, because the costs do not stay inside balance sheets. Now bring this down to where it actually lands. On people, on you. When a currency is held below its real value, the effects feel distant, until they aren't. A stronger yuan would mean cheaper imports, lower input costs, less pressure on households already squeezed by slow growth. But holding the currency down does the opposite. It subsidizes exporters. It shifts adjustment away from firms and onto citizens. Wages lag. Purchasing power erodes quietly. The burden of imbalance is socialized. And outside China, the story flips. Manufacturers face a flood of competitively priced goods. Jobs come under pressure. Politics hardens. This is why trade imbalances stop being technical debates. They turn emotional. They turn political. If you've ever wondered why trade tensions keep resurfacing, even without a formal crisis, this is why. Because exchange rates decide who absorbs the cost of adjustment, and someone always does. You can ignore currency policy for years, but eventually it reaches into prices, jobs, and stability. That is the human edge of this system. And it explains why patience abroad is thinning, which brings us to the global consequences of a yuan that cannot stay still forever. Then zoom back out, because what is happening to the yuan does not stay inside China. A currency that remains undervalued at scale does one thing reliably. It exports pressure. Trade partners feel it first in data, then in factories, then in politics. When export volumes surge far faster than global trade, the system starts to bend. Not immediately, but visibly. Governments face choices they would rather avoid. Do nothing and absorb the imbalance, or respond and risk escalation. This is why language is changing. Why institutions that once spoke softly are now clearer. Why trade frictions resurface, even without new tariffs announced. The problem is not a single policy. It is persistence. A surplus that keeps growing forces a reaction somewhere else through trade defenses, through currency scrutiny, through geopolitical tension. And once trade becomes politicized, it rarely returns to a purely economic space. This is the danger of managed stability. It looks calm, but it transfers strain outward. The world has absorbed China's surplus for years. That capacity is not infinite, which means the future is no longer about whether adjustment happens, but where, and that leaves us with three possible paths forward. Then let's talk about what comes next. There are three paths from here. None are clean. The first is controlled adjustment. The yuan is allowed to appreciate slowly, 2 or 3% a year, enough to signal movement, not enough to trigger a rush. This buys time, but it does not fix the real undervaluation. The surplus keeps expanding, and pressure abroad continues to build. The second path is forced correction. Trade partners lose patience. Defensive measures spread. Scrutiny hardens into action. Adjustment happens outside China, through barriers, not prices, through politics, not markets. This path is disorderly, and once it begins, it is hard to stop. The third path is internal shift, a genuine rebalancing, less reliance on exports, more domestic demand doing real work. This is the cleanest solution and the hardest because it requires choices, not slogans. It means accepting slower headline growth and redistributing adjustment inside the system. History suggests systems delay this choice. Until delay becomes risk, China is not out of options, but it is running out of neutral ones. Which brings us to the final question. Not what Beijing prefers, but what the system will tolerate. What makes this moment different is not panic. It is inevitability. For years, China's exchange rate policy relied on space. Room abroad to absorb surplus. Room at home to delay adjustment. Room in markets to treat imbalances as temporary. That space is closing. The yuan cannot stay both undervalued and uncontested. A closed financial account cannot absorb unlimited surplus forever. And slogans cannot substitute for policy choices indefinitely. At some point, adjustment happens. Through prices, through politics, or through disruption. This is why the currency debate is returning. Not as a technical argument, but as a test of the system's limits. If appreciation is managed too slowly, backlash grows. If it moves too fast, capital surges back. Stability demands more intervention, not